QuickBooks Online 2025 Balance Sheet Report Overview. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser searching for that QuickBooks Online test drive, the free sample company file available to everybody, looking for the result that has Intuit.com in the URL because Intuit is the owner of QuickBooks. We're going to be selecting the United States version of the software, verify that we're not a robot if needed, closing that prior tab because it's no longer needed. We're now in the sample company file for Craig's Design and Landscaping Services, opening the major financial statement reports as we do every time. The reports that are on the left-hand side, we're going to be in the standard tab, right-clicking within the favorites on that balance sheet to open the link in a new tab, right-clicking then on the profit and loss to open a link in a new tab. Let's go over to that balance sheet and close up the ham boogie. I'm going to change the range to that 2-year time frame as we have been doing in the past. 010124 tab 123125 and then select the drop down to see it in years running to refreshing 2024 and 25 side by side. Let's tab it to the right, closing the hamburgers and repeating the range to the same. 010124 tab 123125 tab, selecting the drop down in years running it. Noting there's nothing currently in 2025 except for these little items down below, including not having prior presentation transactions because we refreshed the browser and opened in incognito window so that we didn't pull in the cookies in an attempt to hopefully have as similar a data on our side as your side, which we recommend you do the same so that we have that similarity within the data. All right. Let's go to the first tab now. So we're going to be considering the financial statement reports, the balance sheet report in particular this time. Just a quick note, as we are in the reports, within the favorites, we have the balance sheet and the profit and loss, noting those are the major financial statement reports. Those are favorite reports to everybody, and I would even say they're not even really reports. Those are the financial statements. So they're kind of a level up from the reports. We think of the major financial statements as the end result, as the things that we are constructing, the things that are going to be necessary for the purpose of our constructing, which is going to be at least tax preparation for income taxes if you're in the United States, external reporting, possibly for a loan or for investors, and for internal types of decision making. Remembering that all other kind of reports are usually going to be an extension, giving more detail about one or multiple items on these major financial statement reports, balance sheet, profit and loss, which we could also call the income statement. So that's what we're going to focus in on now, and that means that we're going to spend more time possibly than any other kind of report on these two, the balance sheet and the income statement, because we want to have a grounded understanding of them as the thing that's being constructed, and that will also help us with all other types of reports, which will always feed into these line items, which means we'll already know something about basically the other reports. Now, I just want to point out quickly before we get into the standard balance sheet that there is the summary balance sheet down below. So let's open that one up. I'm going to right click and open that in a new tab. This is going to be our summary balance sheet. I'm going to put that like in the middle here, and let's close up the ham boogie, and I'll change the range to the same 010124 tab 123125, selecting the drop down to see it in years running it. So now we have a similar process with the summary type of balance sheet. All right. So let's give a quick look on what the balance sheet is. It's going to be basically a reflection of our double entry accounting system, the double entry accounting system being universal. It's like math. It's like a formula. So it's going to be the same no matter where you are located. However, the thing that will change based on locations will be laws and regulations. In particular, for bookkeeping, the impact on tax laws is going to be where the major differences are at. So the accounting equation, we can see if I collapse the assets, the liabilities, and the equity, we see our accounting equation, assets equal liability plus equity. Now, one reason we might start with the summary balance sheet is because it is more summarized. It has less detail, and therefore it's easier to lead people in. So, for example, if you are creating a batch of reports that you're going to provide to somebody, possibly a client or supervisor, the top of the report might be the summary balance sheet because it's not too intimidating. It might encourage them to actually open the report, at which point you might have more detailed reports inside. Or if you're giving a presentation, it might be useful to start in a more simplified fashion, even though that you might be saying, hey, that's not enough. I need to give them more detail. They're not going to get the point with just too big high-level view, but you at least have to get them engaged before their eyes glaze over, and then you can get into possibly the more detail, which might be the longer type of report. So from the most basic level, we have the assets equal liabilities plus equity. That is the double entry accounting system. Rather than in forms of debits and credits like a T account, it is in the form of an accounting equation, noting that from a construction standpoint, from an accounting standpoint, we will typically think of things in debits and credits because they're more efficient, but then format them in terms of an accounting equation, which is the balance sheet, assets equal liabilities plus equity, because that's more universally understood. So it's not quite as efficient as debits and credits. That's why we still use them. So they're still useful to know, even with software, because it's a more efficient way to look at things oftentimes. However, when we're discussing with other people, we're going to be using the accounting equation typically in the form of the balance sheet. So that leads to the question of what are assets, liabilities, and equity. Assets represent what the company owns in order to help them to generate revenue. So remember that our major objective here is going to be revenue generation. So that's going to be the idea from a business standpoint. You might say, no, my objective is to improve the world through this thing that I'm doing or creating. Well, that might be, you might be like SpaceX and you're going to save the world by going to Mars or something like that. And then when the Earth gets hit by an asteroid, we won't all die and so it's okay. You have that's your mission statement, let's say. But from a viability standpoint, from a business standpoint, we still have revenue generation as basically our goal. So given that as the goal, what are the assets? The assets are there in order to help us in the objective of revenue generation, typically earning revenue within whatever activity the business was created for. If it was SpaceX, space travel revenue generation, right? If we're a restaurant, then of course we're going to generate revenue through the service of the food and so on. Then we have the liabilities and equity. So what are the liabilities then? Liabilities are going to be things that we owe to third parties. So that's going to be often the bank and possibly accounts payable, other vendors that we owe money to. And then we have the equity, which represents what we, the owners, own in the business in essence. So the assets, you can think of these as two sides of the coin. The assets, what the business has, measured in dollars. Liabilities and equity, the other side of the coin, represents who has claim to the assets of the business. Liabilities being third-party people like the bank for loans. Equity being the owner of the business, which means we can algebraically reformat this calculation to assets minus liabilities, what the company has minus what we owe to third parties like the bank, equals what is claimed of the assets to the equity or owners. That's like the net value or book value of the business. Now, equity gets a little bit messy, however, because it will be dependent on the type of organization in terms of how it will be structured. So if we're talking about a sole proprietorship, the equity is pretty straightforward because you only have one owner. So that represents the amount of the assets or the value of the assets that are attributable to the owner as opposed to the liabilities. If you're a corporation, it's still usually basically pretty easy. That's the beauty of the invention of the corporation, because we can think about the equity as being attributable to the owners, who are the owners' shareholders in that case. But how do we allocate the ownership per share? we basically break that ownership into equal values represented by the stocks, which is kind of similar to an idea of money, of cash having an equal value. And then we distribute those the ownership out based on how many shares of stock is earned, which means that the equity section is still pretty basic, even though you're going to have a whole bunch of different owners, as opposed to a partnership, which is possibly the most complex kind of structure, because you could have 2 or more people as the owners. You could have a bunch of partners involved, but instead of equally breaking out the ownership using shares, you're going to use partnership agreements. And that means that you're going to have to track actual different equity accounts per partner. And they're not all going to be the same. You're going to have to track the increases and decreases, the allocation of the income based on the partnership agreement, which is kind of a specialty kind of field in and of itself. And you got to basically spend some time to pick that up clearly. All right, so then if we go into each of these, then we could say, all right, let me go into the assets. What kind of assets do we have here? Notice the categorization. We've got the current assets and then bank accounts, the accounts receivable, and the other current assets. Notice you might be asking, where do they come up with these categories, as opposed to if I went to the full balance sheet under assets. Let's just do it this way, where we have current assets and then all this stuff in current assets and then fixed assets, right? So over here on the condensed, we have the current assets and then the fixed assets, and under current assets, bank accounts, accounts receivable, other current assets, and then our fixed assets. Whereas in the extended version, we have the current assets here and then all of this detail within the current assets, and then the fixed assets, all of the detail in the fixed assets. So to understand how the system is doing that, let's go back to the first tab, and I'm going to go into the sales on the left-hand side, and let's go into our transactions, and then let's go into our chart of accounts. Into the chart of accounts, I'm going to close up the ham boogie up top, and you can see we'll talk more about the chart of accounts when we start a new company file and we set up the chart of accounts from scratch. But you can see at this point in time that it's organized by the account type. So every time we set up a new account, we're going to give it an account type. The account type can be thought of as assets, liabilities, equity, income, and expense, balance sheet on top of the income statement, but further broken down into the bank account, which has a specialty component because the bank account could be connected to the bank feeds, and therefore QuickBooks needs to identify it differently in order to give it that functionality. Accounts receivable is a current asset, but it has a specialty component because it needs to tie out to the subledger related to who owes us money, the customers. And then the inventory, which is going to be where the other current assets start, even though it has a subledger as well, but there's less connection with it. And then all of the other current assets. So you can see what is the summary thing doing over here. It's taking these account types as the summarization factors. It's summarizing them by account types is the general idea. So that's, you can just get an idea of how this is being constructed, how the summarized item is being constructed. If I went to the full balance sheet, you could still kind of get to the summary. How? Because you see these little triangles. This triangle represents assets, liabilities, and equity. And then this sub-triangle represents another normal category within the balance sheet of current assets. And then these triangles represent the account types. So bank account type has a specialty component because it could connect to the bank feeds. Accounts receivable has a specialty component. So even though there's only one account within it, it still has its own kind of triangle. And then the other current assets are all the other current assets that don't have a special need, like connecting to the bank or having the subledger for accounts receivable. And then you've got the fixed assets, which have a special component because those are going to be the property, plant, and equipment that are going to need the subledger of accumulated depreciation. And then within the liabilities, you have, once again, total liabilities here, which is a normal subcategory. current liabilities, which is going to be a normal subcategory for a balance sheet. And then we have the categorizations of the account types. That's what these triangles are. Accounts payable having a special need for vendors, subledger. Credit cards are like bank accounts, right? Because they can connect to the bank feed, so they have a special need. And then all other current liabilities that don't have a special need are under this triangle. And then these are the long-term liabilities, which is a normal categorization. And then under equity, these are all the triangle for the equity type of accounts. And we have the different components within the equity. So let's now open these up like one by one and just kind of go through them in a little bit more detail here. So we've been working now in the assets and in the current assets. So let's just close this up to the assets. So within the current assets represent assets that are going to be consumed. You could say usually basically within a year is the general idea. And the first current asset is usually in normal parlance in a balance sheet, the cash and cash equivalents. But in QuickBooks, they use a little bit different terminology. Why? Because we have to list out the checking account being different than basically all other cash equivalent type of accounts, because they have, again, that special need of being able to connect to the bank feeds. So now we've got this term that's not really normal on like a normal balance sheet of the bank accounts, where we have the checking account and the savings accounts. Now you might be able to change some of these terminologies if you wanted to use this for external reporting purposes, in which case you might want one line item for cash and cash equivalents. But that's that. Now notice what's also not under this categorization is the clearing account for undeposited funds. So if you are collecting at a register or you're using credit cards and you're putting them through undeposited funds so that you can then deposit them into the checking account, then the undeposited funds isn't going to be under the banking, even though you would think it would be a cash type of account, and is a cash type of account, because it doesn't need a special subledger. Therefore, it's going to be under the other current assets, undeposited funds. That means when you're kind of grouping your cash together, if you have items in undeposited funds, you have to include that in cash and cash equivalents. For example, if you're tying this out to the statement of cash flows for the cash equivalents, you're going to need to pull in that number, which can be a little bit confusing. Hopefully, the undeposited funds will typically be cleared out as you have cleared them out to zero, as it is a clearing account. All right, and so then we've got the accounts receivable. So note that the accounts receivable would only be used if you're in an industry where you have to do the work first and then invoice the client, in which case you have to track the outstanding receivables, and that means you're going to have the accounts receivable, which will have a subledger breaking out the receivables by customer, which we will typically track internally by going to the first tab, ham boogie, and the sales tab. And we've got our customers over here, right? So we could track the customers that have outstanding balances within them. So notice from a reporting standpoint, this is kind of ugly because you don't typically have more than one accounts receivable account. So to have a sub account and the accounts receivable is kind of ugly. But you can see why that would happen functionality wise within QuickBooks, because they're giving a separate triangle for every account type. And accounts receivable needs its own account type because it has a special need to track the subledger for the accounts receivable by customer. Now, this might be if you add another account, say, which is allowance for doubtful accounts, for example, to estimate the receivables not collectible, this dropdown might make more sense if you can group that allowance account in the same category, but we won't get into that right now. And then the other current assets, this is where all the other current assets would be if they don't have a special need. So remember, normal bookkeeping or normal financial statements would not have a special breakout for the banks or a special category for accounts receivable. They would just be listed under current assets. They have a special breakout because of the functionality needs being different account types within QuickBooks. And then all the ones that don't have a special need are under just the other current assets, including inventory, noting inventory does have a subledger need, but the subledger isn't tied exactly, even if you're using a perpetual inventory system, to the account as it is with accounts receivable. In other words, QuickBooks' subledger for accounts receivable is forced basically to tie in to this account, because every time you post something to accounts receivable, it forces you to add a customer. It doesn't do that with inventory. Inventory has an inventory subledger, which should tie out here, tracking inventory by unit as well as dollar amount if you're using a perpetual inventory system. But QuickBooks will allow you to post to the inventory account without entering an item, which means that if you do that, your subledger will not match what's on your balance sheet, which will cause you a problem. Now, QuickBooks does that, of course, because you might not be using a perpetual inventory system. You might be using a periodic inventory system, in which case it would make sense to post something to inventory without hitting the subledger. We'll talk more about that later. Then you've got your undeposited funds. That's that clearing account that really should be up in the cash and cash equivalent area, but will go to zero after we clear it out, after we make the deposit. So we'll talk more about that as we go later. Then we've got the fixed assets. These are the long-term type of assets. Now, notice that all of your assets, you can kind of think of them as investments. And this term investments is a little bit confusing, because if you hear the term investment, you're usually thinking stocks and bonds, most likely, because that's where we invest things for retirement and try to gain or generate income on it and whatnot. But note that everything on the balance sheet is basically an investment, because we're investing in the asset to help us to generate revenue. So in other words, if we had cash, we could basically invest the cash in the business. We can buy like expenses, in which case we would have consumed it. If I pay for the utility bill, I have consumed something in the service of helping me to generate revenue. But if I buy something like a truck, then I haven't consumed the truck yet. I bought something to be used in the business for the objective of generating revenue, and therefore it's a type of investment, right? And so even putting my money into the business account instead of my personal account is really kind of a type of investment, because the idea would be I have the money in the business in order to buy something in the future that's going to be used in the business, either expenses, paying the utility bill, telephone bill, or paying for fixed assets like the truck in order to help me generate revenue in the future, right? So that means that these down here are fixed assets, long-term assets, things that we couldn't expense because we have not yet consumed them, therefore are forced to do the accrual thing, putting them on the books as an asset, even if we're on a cash-based system for like taxes, because the tax code will force us to still put it on the books as an asset. And the most common and clear example of that would be, for example, if you bought a building for like $100,000 cash, most of us still wouldn't think, well, we should just make a building expense for the $100,000. Why? Because no, that doesn't make sense, because we bought the building, it should be an asset. So that kind of makes sense. But if we were on a cash-based system, we wouldn't. We would just expense the $100,000. So that's just an example. The trucks, the automobiles, the property, plant, and equipment all have a similar functionality. We are going to have a subledger with them, but oftentimes, particularly in the United States, we don't track that subledger within QuickBooks, because we're going to need to track it for income tax reporting purposes anyways, meaning we're going to have to track it in tax software according to the tax code, at the least, the tax code being different than often generally accepted accounting principle codes or accrual concept codes. But we need to do that in order to be in compliance with the tax code. And if we already have the subledger, which will be a complex subledger in the tax code, in the tax software, we might as well also use that for our bookkeeping subledger. Otherwise, we're going to have two subledgers that are going to be quite complex that we'll have to reconcile all the time. So that's why oftentimes we will have a subledger that won't be in here, but we need to make sure that we track it closely in the subledger that might be generated from tax software. All right, that's going to give us our total assets, and then we've got the liabilities and equity. Let's go into the liabilities first, and we've got the current liabilities. That's a normal financial statement subcategory representing those liabilities that are due within a year. An important subcategory, although the time frame is arbitrary, because we want to see the stuff that's going to be due soon, because I want to note that I have enough assets to pay it. Why is that important? Because it's possible for me to have a lot of net assets and still be illiquid, meaning I can't pay my bills. It's like, how can you not pay your bills? You have like millions of dollars in net assets. Well, that's possible, but the classic example is like a farm, for example, where you might have millions of dollars in net assets, but most of it is in property, plant, and equipment. I don't have any cash, right? So I can't pay my current bills that are becoming due if I don't have enough cash flow to pay the current bills, and I don't want to sell the farm or mortgage the farm, sell the equipment or mortgage the equipment in order to pay the current liabilities. That's the issue, that's the problem. So we want to basically kind of think about our current liabilities, which are going to be the accounts payable. Typically, that's going to be the amount that we owe the vendors when we enter bills, which is something we might not do as much if we're a small business, but as businesses get larger, it's going to become more important to track the accounts payable rather than just pay them with, say, bank feeds or credit cards when they become due, because the dollar amounts might be larger and the number of transactions could be larger, making the time value of money more significant and therefore worthwhile to see if we can pay our bills like 15 days later or something like that, right? If I pay a $100 bill 15 days later, not that important if that's the only bill I have. But if it's one of a thousands of bills that I have that I could pay 15 days later, that starts to become significant for cash flow purposes and time value of money purposes. So then we have the credit card. Now the credit card needs its own separate account as well, as does the accounts payable. The accounts payable, by the way, needs its own separate account because we're tracking the accounts payable by vendor in a similar way as we track the accounts receivable by customer. And we have the similar functionality that looks funny from a financial statement reporting because we would have a sub account with only one account in it. That's redundant. We don't really need that, but you can see why it happens functionality wise from the QuickBooks standpoint, because it has a sub account for each new category. And then we've got the credit card. So the credit card has its own subcategory because, like the checking accounts, it can be connected to the bank feeds, and therefore it has the necessity of the bank feed functionality, and therefore has a subcategory for it. Noting that oftentimes people don't think of credit cards as similar to the checking account. It can be a little bit more confusing to think of the credit card payments coming through the bank feeds, but it's actually easier because the credit cards, whenever you make a payment with a credit card, it will almost certainly be an electronic type of payment. And therefore, unlike the checking account where you might pay something with cash, for example, or you might have checks that are going to be involved when you make payments. Those won't be the case with a credit card. Everything will be electronic, and therefore normally, especially for small businesses, you might just simply record credit card transactions as they happen, as they clear the bank, depending on the bank feeds in order to actually construct that part of your financial statements, which is generally an easier thing to do. And it's just like when you pay for something with cash, except that instead of the checking account going down, the liability account is going up. You don't have any deposits in the credit card. All you have are the payments, the paying off of the credit card balance. All right, and then we've got all other categories are going to go into the other current liabilities, which in this case includes the sales tax, which QuickBooks, sales tax is a type of consumption tax. So if you're outside of the United States, you might have a consumption tax, similar kind of thing. We charge people and we have to pay them. Taxes are going to be the thing that differs from place to place. And that's mainly here. And then we got the loan payable, noting that loan payable is going to be one of the confusing components because you might have a loan that has a short-term and long-term component to it. So if I took out a loan similar to like a mortgage, most people are familiar with installment loans like a mortgage type of setup, although a business loan doesn't necessarily have to follow that same structure. But let's say it does. you pay off the loan monthly, you pay off a portion of the interest, which is the rent on the loan, and the principal. That means that the amount of the principal that is due within a year technically would be a current liability, and the amount that's going to be extending beyond the year is long-term. And you can imagine why that's important, why that makes sense, because if you're on that farm, for example, the mortgage on the farm is going to be the current portion of that. You're going to have to pay that soon. You got to make sure you have the current liabilities to pay that. And then the stuff that's not going to be due within a year, then you might not have the money now to do it, but hopefully you're going to generate money and you'll be able to pay those a year later. If you can't, how can you fix that? Well, one way you could do it temporarily is to shift some of the short-term debt to long-term debt, extending the terms of the loan, right? That can make you more liquid possibly in certain scenarios, although it will run into a wall, that strategy at some point. So then we have the long-term liabilities, which typically don't have much in them, except in this case, of course, the loan payable, the long-term portion of the loan payable. Now note, breaking out between short-term and long-term portion of the loan is kind of a pain, and we'll talk more about how to do that later, but typically you're going to want to do that with adjusting entries possibly, because from a loan standpoint, you possibly want to track your loans, tying them out to the loan balance of possibly an amortization schedule, which means that you want a different account per loan that will easily track that. And breaking out the short-term and long-term portion will be tedious if you do it after every payment. Therefore, it makes more sense to do that periodically at the end of the month, end of the quarter, end of the year when you do your financial reporting. All right, and then we've got the equity section. This represents what assets are attributable to the owner as opposed to third-party liabilities, whether that owner be a sole proprietorship, a partnership, multiple owners, or a corporation where the owners are represented as shareholders. So if you think about equity just in total, it makes sense no matter what the entity is. I don't care. I'm just going to say the owner or owners, right? Meaning all owners as a collective, if there's more than one, is going to be the net value of the business, right? And that net value of the business we can think of as assets minus liabilities is going to equal equity, the net value of the business. And you can also think of it as how you generated the net value of the business. Where did it come from? When you start the business, you finance the business typically. So so the finance comes from a loan or from you, the owner. So if the owner put money into the business, then that's going to be contributed into equity. Where does equity come from after that? Well, hopefully you generate revenue. And if you generate revenue, then you can put the revenue back into the business instead of distributing it, in which case you would have accumulated revenue, accumulated earnings over the time of the business. So those are the ways that equity could go up. So in other words, how could equity go up? Well, the owner can put money in, which typically happens at the start of the business. And if it's a sole proprietorship, you, the owner, put money in. If it's a partnership, the partners put money into the business, which would impact their individual capital accounts, which we would have to track separately. If it's a corporation, the corporation issues stock, which means people are paying for the value of the business. And the stock portion then represents, in essence, the owner investment in the business. The other way that equity goes up is retained earnings, which means that we generate revenue, and this is how the balance sheet is linked to the income statement. The income statement represents performance. We generate revenue over a time frame, which then is going to flow into the balance sheet as earnings. So that's going to be the retained earnings, the earnings that have gone up, but we have not distributed them to the owner. And then how does equity go down? Equity is going to go down typically by the distribution of the retained earnings or the equity to the owner. If it was a sole proprietorship, that would be in the form of draws. We would just take money out of the business typically. Partnership also draws, meaning different partners would take money out of the business, but we would have to track that per partner so that we can track each partner's equity account in a similar way as we would track, say, accounts payable by vendor. And if it was a corporation, we call them dividends. Now, dividends, you can't just draw out, right? Because that means the dividends have to be agreed upon so that all shares get an equal disbursement of the dividends, because that's how we make all the shares the same, which is the thing that made the corporation construction easier by giving shares that are all equivalent. So the trade-off of giving shares that are all equivalent is that we have to make the distributions on a per share basis, and that's going to be more of a bureaucratic kind of process, so that we can keep everything basically the same is the general idea with that. Okay, so that leads into how is the balance sheet tied into the income statement, otherwise known as the profit and loss. We'll talk about the profit and loss more later, but notice that the balance sheet is as of a point in time, basically just has one date up top, although we put 2 periods here. Whereas the income statement is a performance statement. It will typically say on the heading, it's going to be from one period to another period. For the period ended is a traditional way that it's going to be stated. And that means that it's going to have a starting and an end. So this is the performance statement. This is how well we did over a certain time frame. And therefore, you can think of this statement as kind of like part of the balance sheet. In other words, the bottom line of the income statement, the 180131, is going to roll into the balance sheet over here. So QuickBooks actually puts the net income in here so you can see that. That's useful. Most online softwares do that, but it also becomes a problem if you have like a partnership and you need to allocate the income to the partnership account in accordance with the partnership agreement, because now you have this income line item that's down there that looks kind of funny when you do that. But it's supposed to give you an idea of that relationship, and you can see that that net income, when I move into 2025, then flows in to the retained earnings, the earnings that have been accumulated that have not been distributed out, and then we have net income for the current period, 2025, down below, which is currently a loss at this time. So that means that QuickBooks is doing what we call the closing process automatically, meaning if you did this by hand, what you would do is you would create, your income statement, and then you would have to close out the income statement to the balance sheet so that you can then start the new period going forward. But QuickBooks is doing this as we go. But if you're doing it manually, you could close things out on a monthly basis if you wanted to, or a quarterly basis. QuickBooks isn't going to do that. QuickBooks is basically going to close things out on a yearly basis, typically. So that means that, like, you might think, like, if I ran the report for like a month of 01/01/24 to 01/31/24, that it would, or let's say we go, what are we on to? It doesn't have anything for that month. Let's go from 10/01/24 to 10/31/24 and run that. And so now we have net income at 204. Let's do the income statement over here from 10/01/24 to 10/31/24. Run that, and the net income is 112.92. If I go back over here, you would think that would be the amount in the equity section. Oh, it's not, I'm in the wrong one. Run it again, but it's not. It's 204.17 because it's giving us the net income on a year-to-date basis. So in other words, if I go back on over here, so this is the net income for that month. If I was to go from, I believe, 01/01/24 and run it, let's check that out. So now we're at the 204.17. And that should be over, is that the right one? That's the wrong one, 204.17. So that's just something, so it's great that QuickBooks will do the closing process for us. But when you start to think, oh, I should do the closing process for a month, I want to close it out on a quarterly basis or something like that, it's not going to work exactly that way on the balance sheet because it defaults to closing everything out on basically a yearly basis. So just kind of keep that in mind. Once you that'll kind of mess your thinking up sometimes when you start to think about the closing process, closing out a month versus a quarter versus a year. All right, so that's the general idea on the balance sheet.